Raymond sat completely motionless, staring at his account balance summary. $40,000 gone, not because of a scammer, not because of a risky financial decision. Raymond was a careful, methodical retiree who had followed every guideline available to him. Yet, across 3 years, 9 invisible forces had quietly hollowed out everything he had saved for retirement. My name is Daniel Hartwell. Today, I am walking you through exactly how Raymond watched that money disappear, and, far more importantly, how you can shut every one of those drains down before your next billing cycle even arrives. Because the final issue on this list alone strips the average senior of more than $8,000 every single year, and your own personal attorney could be charging you for it at this very moment. If you leave this video before it ends, you will continue funding services that should be costing you absolutely nothing. Stay with me through the final second. I am handing you the precise forms, the direct phone numbers, and the word-for-word conversation scripts you need to get your money returned. Let us go take back what is rightfully yours. Raymond's first devastating blow arrived on a Thursday afternoon. He pulled open his Medicare summary notice and found an unexpected $400 deduction being pulled directly from his monthly payment. Here is exactly where the system breaks down in plain view. The government was collecting a premium surcharge based on income information that no longer reflected his reality. Officials were referencing his taxable earnings from 2 years prior, but Raymond had stepped away from his career the year before. His actual current income was considerably lower than what the automated system was using to calculate his charges, yet the processing system continued measuring him against his former financial picture without any adjustment. He had no idea he could formally challenge it, so he quietly absorbed the cost month after month. The solution is one uncomplicated document called Form SSA 44. You submit this as soon as your income drops as a result of retirement, a divorce settlement, or the death of a spouse. It requires the agency to conduct a completely fresh calculation grounded in your current income reality rather than historical figures. Once the request is approved, the excess premium charge is removed going backward, meaning you receive a lump sum reimbursement covering every month of overpayment. That single piece of paper can recover up to $8,000 in a single year. Raymond assumed the difficult part was behind him. He believed his healthcare coverage situation had finally been corrected, but the next drain was concealed right inside his medicine cabinet. Enormous numbers of retirees continue paying prescription drug costs they no longer carry any legal obligation to pay. Beginning in 2026, federal legislation placed a firm cap on annual out-of-pocket drug expenses at $2,000. But the software system running Raymond's pharmacy was still calculating his charges using the previous year's rules, collecting $50 co-payments even after he had already passed that legal maximum for the year. He had absolutely no awareness that the system was completely failing to track his cumulative annual spending. Correcting this requires only a single telephone call directed to your pharmacy's billing department. No complicated terminology is required, only one specific legal phrase, claim adjudication. Simply state, please confirm that my claim adjudication is accurately reflecting the 2026 out-of-pocket maximum. If the billing representative pushes back or expresses uncertainty, contact Medicare directly and submit a formal written request for a claims reprocessing review. That one focused conversation recovered $800 for Raymond. But the financial trap that followed was not hiding in his medicine cabinet at all. It was arriving in his mailbox every single season. Raymond examined his property tax statement and could not believe what he was reading. $1,900 more than what his neighbor directly across the street was paying for an essentially identical home on the same block. The explanation was straightforward. 68% of counties throughout the country do not automatically enroll seniors in available homestead exemptions. Instead, those counties issue a standard tax bill and rely entirely on the assumption that you are either too overwhelmed or too exhausted to push back and ask questions. In 2026, states significantly expanded their qualification thresholds for these exemptions, which meant Raymond's exemption should have protected an additional $50,000 of his home's assessed value from being taxed at all. He had naturally assumed the county assessor's office had applied his senior discount without being specifically asked to do so. They had done nothing remotely resembling that. To address this effectively, never open the conversation with, "Am I eligible?" Front desk employees will provide you with outdated and frequently inaccurate information in response to that question. Instead, ask this precisely worded question. Has the senior homestead exemption threshold been updated for 2026, and what specific documentation is required to claim the revised exemption amount? Government offices respond differently to precise and informed language because it clearly communicates that you already understand the legal framework involved. That one focused and deliberate question alone saved Raymond $2,000. That represents approximately 6 months of grocery spending for a typical household. He believed the financial bleeding had finally been stopped. Then the utility company moved in without making a sound. Electric and natural gas providers are legally required to offer senior assistance programs to qualifying customers. These are not voluntary acts of goodwill or corporate generosity. They are government-mandated discounts reaching up to 30% off standard rates, yet utility companies systematically bury this information inside documents stretching 80 pages in length and train their customer service representatives to redirect and deflect callers who inquire about reduced rates. Raymond paid the full standard residential rate for 5 consecutive years because he had absolutely no knowledge that an alternative pricing tier even existed for people in his situation. When he finally picked up the phone to call, he did not simply ask whether any discount was available. He stated directly and clearly, "I am requesting formal enrollment in your federally mandated senior assistance program." The word mandated was a deliberate and strategic choice. Customer service representatives receive specific training to escalate calls that contain that particular language immediately, because failing to properly enroll qualified seniors in these programs triggers internal compliance and audit consequences for the company. A single carefully chosen word changed the entire trajectory of the conversation and saved Raymond $1,440 every single year going forward. 4 separate financial drains identified, thousands of dollars recovered. But what came next left Raymond absolutely speechless. The most damaging loss of all had nothing whatsoever to do with the government. His own bank was responsible. Raymond had been quietly absorbing a $25 monthly account maintenance charge on his personal checking account for 3 consecutive years. $900 had simply evaporated without any explanation or notice. Federal guidelines explicitly restrict financial institutions from billing customers aged 65 and older these standard maintenance fees. But major banking institutions depend entirely on your inertia and your built-in assumption that these charges are simply unavoidable facts of account ownership. Telephone-based customer service representatives do not carry the authority to permanently eliminate these fees from your account. You must physically enter the branch location, make direct eye contact with the branch manager specifically, and state clearly and without hesitation, "I am 65 years of age or older, and I am requesting that my account be reclassified to the appropriate no-fee senior banking product. Bring your government-issued photo identification with you. If the manager declines your request, file a formal complaint through the Consumer Financial Protection Bureau's online submission portal. Banks consistently resolve those formal submissions within 72 hours of receipt. And those $3 ATM surcharge fees Raymond had been absorbing every single week without complaint? He began collecting and saving every receipt and submitting a consolidated monthly reimbursement request directly to his bank's compliance department. They processed and honored every single request without any resistance whatsoever. Raymond was beginning to genuinely feel as though he had reclaimed meaningful control over his financial life. Then his tax preparation software quietly deceived him in a way he never anticipated. 12 states across the country continue taxing Social Security benefits, but 8 of those states quietly raised their applicable income qualification thresholds heading into 2026. Raymond's combined annual income fell below $50,000, which meant he legally owed absolutely zero state income tax on those Social Security benefits. However, his tax preparation software was still operating entirely on the prior year's rule set and calculated his liability incorrectly as a direct result. The correct solution is to stop relying on the software entirely for this specific calculation. Request a Social Security benefit taxability worksheet directly from your state's Department of Revenue and complete the entire calculation by hand using current figures. Then file an amended state tax return based on those corrected and verified numbers. That manually completed worksheet returned $1,200 directly into Raymond's account. He genuinely believed at that point that every problem had been fully identified and resolved. He was completely certain of it. Then the next situation very nearly dismantled his entire financial future in one moment. Raymond spent 3 weeks recovering inside a hospital following a serious health event. During that period of recovery, confusion, and medical focus, he missed a scheduled premium payment on his long-term care insurance policy. The insurer terminated the policy as a result. He believed his coverage had disappeared permanently, with no realistic path to restoration. Insurance sales representatives never voluntarily disclose information about alternative available options because their compensation structures are tied directly to selling new policies rather than preserving or restoring existing ones. But the law actually requires insurance carriers to present policyholders with a premium stabilization option under these circumstances. Rather than contacting the company's sales division, Raymond reached out directly to the policyholder advocacy line within the organization. He stated simply and clearly, "I am requesting a premium stabilization option." The insurer was legally required to provide him with a reduced benefit continuation offer within 10 business days of that request. He retained his coverage at a substantially reduced ongoing cost. He had survived the medical emergency. He had salvaged the insurance policy. He was completely convinced that every financial problem was finally and permanently behind him. Then came the final and most stunning revelation of all, the $8,000 mistake that nearly no one sees coming. Raymond's estate attorney delivered an invoice for $8,000 to prepare and file what the attorney described as a protective federal estate tax return. Simply a precautionary measure, the attorney explained reassuringly. Here is the actual reality of the situation. The federal estate tax exemption threshold sits at nearly $14 million per individual in 2026. If the total value of your estate falls below that ceiling, you owe the federal government absolutely nothing in estate taxes. Filing a so-called protective return is entirely unnecessary and provides no meaningful legal benefit for 99.7% of retirees living anywhere in this country. It generates substantial attorney billing revenue without delivering any genuine or measurable legal protection in exchange. Raymond studied the invoice carefully. He picked up the telephone and stated with complete clarity, "My total estate falls well below the 2026 federal exemption threshold. I am formally declining the protective filing." He preserved $8,000 in under 5 seconds of conversation. That amount represents the complete cost of a roof replacement. It covers an entire decade of property tax payments for many households. Raymond did not lose $40,000 because he was careless or financially uninformed about basic money management. He lost it because no one ever sat down with him and honestly explained how these systems actually function in practice. He trusted that the county assessor's office, the bank, the pharmacy, and his own legal representative were actively working to protect his financial interests. Not one of them was doing that. They were simply processing paperwork exactly the way they had always processed it, without any consideration of whether the outcome was fair or accurate for him specifically. But you are no longer operating without that knowledge. You are now fully and specifically equipped to act. Here is your precise action plan for the next 72 hours. Tonight, download the 2026 Senior Exemption Resource Guide, linked in the pinned comment directly below this video. It contains every relevant web address, form number, and conversation template corresponding to every single financial drain we addressed throughout this video. Tomorrow morning, contact your utility provider and your county property appraiser's office using the exact phrasing I walked you through. Both calls combined require approximately 20 minutes of your time and have the potential to generate more than $3,000 in annual savings starting immediately. This week, visit your bank branch in person and submit Form SSA-44 if your income has declined since the reference year being used by Medicare. Do not allow these steps to drift across weeks or months without action. Forward momentum compounds on itself in powerful ways. Procrastination quietly and consistently erodes the very savings you have already worked to recover. Every single dollar you reclaim is a dollar that stays inside your household rather than sitting inside a government processing account or appearing as revenue in a corporate financial report. This is not about adopting a frugal lifestyle. This is about fundamental and basic fairness. Retirement was never designed to be a period of generating new wealth from scratch. It is about protecting and preserving the wealth you already built through decades of consistent and dedicated work. I am Daniel Hartwell. Guard your financial future with intention. Claim every exemption you are legally entitled to receive, and never again allow silence or unawareness to drain what rightfully and completely belongs to you. Subscribe to this channel right now, because next week I am uncovering 5 critical Medicaid planning traps that can quietly and permanently devastate the inheritance you intend to leave behind for the people you love most. You absolutely cannot afford to miss that video. Stay safe, stay informed, and I will see you in the next one.